Hello and welcome to FX Street Currency in Play. I'm Matt Brown. I'm joined down the line by Ed Matz from matrixtrade.com. Good morning to you, Ed.
Good morning. It's a shame we had to interrupt our conversation about where Donald Trump tweets from, but never mind.
We'll pick that up after the show. Anyway, let's have a quick look at the top trends today. UK August jobs report, unemployment rate ticks lower, wage growth disappoints. Moving on, UK, any hawkish BoE repricing only likely to offer sterling a one-time boost. This is according to ING Bank. And finally, euro dollar, open interest in puts rise on the CME. Pound's doing very well at the moment, Ed. Bit of an uptick, bit of a downtick this morning, though, on this jobs data. What's your take on this moving cable?
Well, if you go back a month, it's very much the same thing, Matt. Cable was doing, previously I said 3 steps forward, up, in other words, 2 steps back, but this seems like more like 7 steps forward and 5 back. Cable's basically ratcheting, and I'll show you in a minute, in an upward wedge. There's some very interesting things as it approaches effectively the post-Brexit high of 134.12, 134.45. And it's the same process. It's a pig of a market to trade. I mean, even forewarned is forearmed, you would think, but it's throw away your charts. It's basically, as when I was working at Citibank in London, the chief dealer in New York said, Ed, you put away your charts. What you need to realize, and one thing that moves this market, and it's this, whatever will screw the market, it will do before it goes to where it's going to go. And that's what Cable was doing. Pick a level, pick a high, and it'll go through it and come back. And it's the same story. What is interesting about Cable is essentially 2 things, is the underlying movement in the interest rate differential, and also, more importantly, is the inflows we've seen in Cable and sterling generally in the last 2 to 3 weeks.
Yeah, and we'll come to those slides shortly, but let's kick off with the slides you put along today with Donald Trump there, loading up the dollar on the S&P, the camel's hump after the Trump bump, maybe, with a North Korea missile launch looming in the background. What's your thoughts on this cartoon?
Well, as ever, we're trying to say what's been happening, what is likely to happen. And obviously, if you think about what the market's done in the last week or so, it's been essentially risk aversion movements in the dollar, followed by risk relief, more like risk off, if you like. That's why the dollar's come back, the stocks have gone higher as a reaction to overly negative, pessimistic outlooks. Essentially, what we've got there is the storm in the background, and Donald Trump is loading up the camel. The camel, it says the S&P, because going back along, one thing we're looking for, and still bullish, one thing we're looking for as it breaks, the S&P breaks to new highs, is for a massive turnaround, in other words, a crash. And, you know, a lot of people have said this time and time again, but we've stayed bullish, following some templates from 1929, 1987, and essentially we're coming very, very close. And the question is, because we've seen this time again, Russiagate, even North Korean missile launches, you get risk aversion, and then the market comes back and breaks to new highs. And you ask yourself, well, what is going to be the trigger? Well, that's a really interesting question. Obviously, I don't know the answer, I wouldn't profess to know the answer. But there's a couple of interesting things that are going on. One, firstly, we've seen the crash, or started to see the crash in the stock market. If you look at the US market represented in euros, Canadian dollars, gold, it's already well down from its highs. Now, the interesting thing about that is to ask yourself, well, why is the dollar moving? Why has it moved 10% lower since Donald Trump said he wanted it lower in February the 23rd? And essentially what it represents is a flight already away from the US. And so the dollar's gone down, stocks are going up. It's come to a point where you almost believe the turnaround will be triggered by the dollar itself. Not necessarily the dollar going down, but the dollar going up. If you look, I mean, grab a chart, look at the S&P in euros, Canadian dollar, Aussie, even sterling now, cable now, in gold. And if the dollar were to go bid, then it might actually be the trigger itself for the dollar to reverse. Because in other words, what we've seen is effectively the beginning of a stock market crash in anything but the US dollar. But obviously the vast majority of US stocks are held by US dollar denominated US funds and people. So if you get that movement up in the dollar, and the S&P can't take it, in other words, the S&P's at new highs and the dollar continues to go up, it will give way. And that's essentially what this cartoon is saying. It is in fact the dollar, just one more thing that may be the trigger. So there's me and everyone else looking at, North Korea National Day thinking, what's going to happen? Is this going to be the straw that breaks the camel's back, or is someone going to resign again? All these questions, maybe it's going to be something elsewhere. It actually could be market driven, but for all the obvious wrong reasons. In other words, dollar's gone down as this disinvestment from the US, or whether it's Donald Trump, or whether it's the consequent movement in interest rate differentials, because a lot of the dollars are just following the interest rate differential. So you ask yourself why they're moving, and it's because effectively represented by the US yield, people are getting very, very nervous. Now, you go back to what would be the trigger. I was saying it could be a dollar rally, ironically, could trigger the whole reversal process. If you look back in 1987, the first 48 hours of the crash, the dollar went bid. And what did dollar yen do? Dollar yen broke down through obvious levels, down through 108.10, even 107.50, and it's ramped. So what we're saying is essentially we're getting very, very close to a very, very interesting, exciting market.
Good stuff. Well, let's look out for that. But moving swiftly on, looking at cable versus 10-year differential now, we've seen a similar thing with euro dollar. Just explain briefly what this means, what this potentially means for cable.
Yeah, right. No market, no foreign exchange market or currency pair can move without its different, or be sustained in any direction without its differential going with it. You get lags and leads, and obviously the euro dollar is still well above its interest rate differential, partly reflected, I think, by that risk premium, maybe people getting overly long at times. But if you look at the cable 10-year differential, you can see that cable's broken to new highs, but the 10-year differential hasn't. In other words, it's saying it can't sustain this move until that differential catches us up. Either the UK gilts are going to move, or the US bonds going to move, or cable's actually not going to stay up it. And we've seen that today as it's broken to new highs.
Fantastic. Yeah, so let's move on to the next slide. And still speaking of cable, and you mentioned before the inflows that we're seeing into the pound, and you mentioned before working at Citibank as well. So we're seeing some weekly net inflows into the pound. Just where are all these inflows coming from?
That is interesting. One of the great advantages of working someone like City London, which was at its time, and they would argue still, one of the biggest cable players around, and having customers like Richard Hill from Barclays, big swingers, is they would see the flows. And they, you ask yourself, why are these guys very successful traders? Because they're very savvy, very experienced, they know how markets move, but they see the flows. And one thing that's happened, this slide I'm showing here, the net inflows in cable, or sterling rather, but primarily probably cable, from Citibank, shows you that we've seen in it the highest inflows since June, which actually represents in the last 2 weeks, the highest inflows we've seen into sterling since 2011. Ask yourself, why is that happening? Well, a lot of it is because people are, it's a gradual ratchet, it's sucking longs in, getting people long. But it's also because the corporates are getting very nervous. Since Brexit, they've been saying, well, 120, 130, what do I do? I can't afford to for it to go higher without me hedging or putting in strategies as a result. So it becomes a self-fulfilling prophecy, if you like, because they'll get more and more nervous as it ratchets higher. Now, the real question is the extent to which spec money gets involved, as we've seen in the last 24 hours. Up to new highs and coming back down. Spec money will move quickly in and out and disappear. It's the real flows. And whether this money we're seeing now represents a real flow into sterling that will stay there, I think the answer is probably yes, depending on the scale of the pullback. In other words, if it starts going below 125, they'll say, what the heck did I do? And they'll get out. Until then, it's more of the same, that kind of like 7 steps forward, steps back.
Well, let's see how sticky that money is. And just looking at your next chart, this is the hourly cable chart. Where do we go? Up, then back down, as you say, 7 steps forward or 5 steps back. Where is the pound going to be in a month's time?
In a month's time depends very much on the stock market. And the real question for sterling is, if and when there is a stock market crash, given the Brexit vulnerability of the UK economy and therefore sterling, what will sterling do? You would think it would be more vulnerable than most, Certainly FTSE will get trashed. But what will sterling do? I've got a funny suspicion, well, not a funny suspicion. What we actually think will happen is sterling will weaken initially, but if there is a stock market crash and it comes in the form of even more or even higher US dollar related risk aversion, then you'll see the sterling uptrend will accelerate. But until then, we're going to see more of the same. In other words, we'll get these ratchets, these spikes, new highs, big sell-offs. So in a nutshell, what we've done in cable for the last 3 to 4 months is wedging higher, and it's broken to new highs. This chart was done first thing this morning, so it's already started to come back down. Probably take out 131.78 just to screw people. Again, as usual, take out the obvious levels before it goes to a new high, that post-Brexit high of 134.12, 134.45. Essentially been saying the same thing for the last few weeks, but trying to trade it is it's a challenge for sure.
And looking ahead at the Bank of England on your next slide, in cable, how it trades ahead of the Bank of England, is it priced to disappoint at the moment?
It's priced to disappoint depending on where the spot rate. One thing we do at Matrix Trade is we look at what markets do going into and out of events and see what they typically do. And as a result, you can see on the UK CPI came out yesterday, and obviously it was a beat, it ramped, but you can see also from the beat average, it says it won't be sustained. Partly because people don't necessarily believe the UK figures. Well, what is really interesting is how they're being continually, from any UK release at the moment, it's been front run by about 30, anything from 15 to 30 minutes, telling you or suggesting, I wouldn't say necessarily I believe it, but suggesting someone has the figures. So anyway, cable ramps on CPI, higher than expected inflation figures, and then rolls back down until, you know, either Carney comes out and says something dovish or whatever. But it's essentially taking out the levels and moving back down. As you can see represented, it goes all the way back down, which is in line with that 31.50, 31.70 before it goes to new highs. Into the Bank of England, well, the market will clearly want to hear, well, don't forget these are minutes, will want to hear what the Bank of England's take is on inflation and UK growth and possibly, you know, the risks associated with Brexit negotiations and everything else. And they're likely to be disappointed because either the Bank of England, particularly Carney, is coming out and saying one thing one week and then another, or actually what he's effectively saying is we don't know. We need to see the data, sustained data showing that we've got sustained pickup inflation, that the UK economic growth is stabilizing. And the figures as yet don't actually justify that. So it's likely to be non-committal. If cable is above 133 then, given the CPI figures yesterday, it should go back above 133, then it's likely to come off because they'll be disappointed by what the Bank of England is saying because it's not going to say very much. And I mean, that's the story of this week. I mean, last week was risk aversion, North Korean National Day, and obviously the storms coming through and the extent to which that would damage the US. And short-term belief it won't be a huge damage, although Goldman was putting out some significant downgrades. I think it was yesterday or the day before. It's a long week. But tomorrow is CPI, US CPI. So the market, Bank of England minutes are likely to be eclipsed by how, rather than a cable play or sterling play, it would be a US dollar. In other words, what are the CPI figures going to come out? And 5 months in a row, we've seen inflation not meet expectations. Inflation, the rate of inflation is falling, which, as an aside, is one of the preconditions of a crash. Continual tightening, if you like, either in the form of US rate hikes or balance sheet reduction in a disinflationary growth bull market in US stocks. So for us, the CPI figure tomorrow is really interesting and important. And as you can say, in the euro dollar, it says that it's going to stabilize next 24, 48 hours, probably come down and then ramp on the figure and fade. A lot of these things, people are too nervous. People, it's very whippy, short-term erratic moves. So a lot of the moves aren't being sustained in the short term. If you look back over the last 10 weeks, and clearly we've had some big trends, or the last, since February, we've seen some big trends. But in the shorter term, most of the movements aren't sustained to the extent, going back to the point, whatever will screw the market, it will do. It's almost a question of looking for a level where people will stop out and I'll eat the stops. I mean, going back, talking about some of these big traders, that's what they would do. is they'll look to see the stocks and they'll buy into, if it's breaking down through stocks, they'll buy it, they'll eat the stocks because they know it will come back up. Today's version of that is your Vega options traders, who whenever they see an intraday break, Vega shifts and they cover it and it sends it back into the range. So essentially we've got a mishmash of fades within overall trends, and the trend is clearly a dollar downtrend.
Understood. Finally, to round up, we've got the economic calendar. Well, we've got PPI due out from the US at 1:30. That's probably the big figure today. But as you rightly said, looking ahead tomorrow to the Bank of England, and probably more importantly, the CPI. On that note, Ed, we're going to have to say thank you, but thanks very much for joining us on FX Street Currency in Play, and no doubt we'll catch up with you next week. Thank you very much.